The straddles and strangles are some of the most interesting strategies. They have a lot of plus points and they have a few minus points also. So it's important to understand what these strategies are because they truly represent some great opportunity. So what we're going to do in this course is we're going to look at straddles and strangles, and in part 2 I'll be covering the analysis of straddles, and in part 3 we'll be covering the analysis of strangles. Now, both straddles and strangles involve buying put options as well as call options. So you can just think about that for a minute. You're buying call options and put options. So the call options is a bullish strategy, the put option is a bearish strategy. So what exactly are we trying to achieve when we buy both these options? Now that's the real interesting part, and we'll be looking at both of these in detail. And actually this course on straddles and strangles will give you a great example of how the general dynamics of options work also. So it's a very interesting strategy. In fact, straddles and strangles happen to be one of the most popular strategy amongst options traders, and it's a volatility strategy. As you can imagine, we are long both a call as well as a put option. So both a long call and a long put is a Vega positive trade. So you're going to get benefits from increased volatility when you have a long call and a long put. So now the volatility component becomes double because you have a long put and a long call, and both these options are Vega positive. So it becomes a highly Vega positive strategy. Now, because we have both a long call and a long put, you're fine with movement in either direction, because if it goes up, then your calls are going to make money and your puts are going to lose money. And if it goes down, then your puts are going to make money and your calls are going to lose money. So then you might ask, so what's the big deal? If one of them is winning and one of them is losing, what's the big deal of this strategy? So this is where it gets really interesting. So we're going to look at both these strategies in detail, and you'll see that these can be fantastic strategies. But they do have a few minus points, so we just need to be aware of them. And that's exactly what I'll be pointing out. Both these strategies obviously are non-directional in nature, because you don't care which way the market is going as long as it's moving in one direction. So you do need movement. And we'll see that both these strategies have something called the valley of death. And if your position starts falling into the valley of death as time goes along, then it becomes difficult for the strategy to make money. But that happens over a period of time. So we have to watch for time decay, because these are both long options. So we are exposed to time decay on both the call as well as the put options, because we are long both of them. So two long options are going to double the amount of time decay in your option strategy. And that's why as more time goes along, you'll find that the option or the strategy tends to fall into the valley of death. Of course, this is a slow process. So obviously you have plenty of time and opportunity to make adjustments.